Adjusting journal entries. A demonstration for the adjusting entries chapter, talking about the matching principle and so why we do adjusting journal entries, and an example of each of the kinds of typical adjusting entries that need to be made at the end of an accounting cycle. Adjusting entry for prepaid insurance. An example of an expense that is typically paid in advance is insurance. Insurance policies are paid at the beginning of the policy period. This outlay of cash is recorded in prepaid insurance, which is an asset account. The portion of the insurance coverage that has expired by the end of the accounting period must be transferred to an expense account. For example, on December 1st, Atherton Plumbing purchased a 6-month insurance policy for $600. As of December 31st, 1 month, or $100 of that coverage had expired. The $100 is 1 month. Why $100? Because 1/6 of the $600 is $100. Now, the original entry that precipitated the necessity for an adjusting entry was the purchase of the insurance in the first place. So what I call the original entry is the transaction that occurred that caused us later on to need an adjusting entry, or suggested we would need one. So on December 1st, that's when we purchased the insurance. So we would have debited prepaid insurance and credited cash. And we know both are asset accounts. And of course, we increase assets with a debit, we decrease assets with a credit. The adjusting entry that needs to be made in order to recognize that $100 of coverage that had expired is to debit insurance expense and to credit prepaid insurance. Insurance expense is an expense account going to affect net income, and prepaid insurance, of course, is that asset account that we set up on December 1st, and we have just reduced it by $100. So now the balance in there would be $500, which would be the next 5 months worth of insurance coverage. Another example is the adjusting entry for supplies. Another asset that must be adjusted at the end of the accounting period is the supplies account. All supplies are recorded in the supplies account as they are purchased. By the end of the accounting period, some of the supplies will have been used. The supplies used must be taken out of the supplies account and transferred to the expense account. Information may be given as the remaining supplies were, so you might be told what the remaining supplies were, or the amount of supplies used, which means, we know we used X amount of supplies. This will affect the amount of the journal entry. For example, on December 1st, we purchased $250 in supplies. As of December 31st, only $50 worth of supplies were left. Okay, that means we used the difference. We used $200 worth of supplies. Well, going back to the original entry on December 5th, we bought supplies for $250 cash. Alright, so we debited supplies, an asset account, and credited cash, also an asset account. On December 31st, which is when we need to make this adjusting entry, we recognize that supplies of expense of $200 as a debit and supplies $200 credit. Supplies itself is the asset account. Supplies expense is an expense account. And we know the rules of debit and credit say debit supplies expense to increase it. Adjusting entry for unearned revenue. If payment for goods or services is received before the goods are delivered or the service is performed, it cannot be recognized as revenue. Revenue can be recorded only after it is earned. Therefore, when payment is received in advance, it is recorded in an unearned revenue account. This is a liability account. By receiving payment, the company has obligated itself to deliver the goods or provide the services for which it was paid. This obligation is expressed in the accounting records as a liability because we owe something. If a portion or all of the revenue has been earned by the end of the accounting period, some or all of the unearned revenue is transferred to a revenue account. So for example, an adjusting entry for unearned rent. On November 2nd, Huber Rental Properties received 3 months' rent, totaling $2,400 in advance for one of the commercial properties. As of December 31st, 2 months worth of this rent had been earned, namely November and December. So that third month is January, which is in the next counting period. So if we take $2,400 and divide by 3, that tells us it's $800 a month for rent times 2 months, November, December, and that's $1,600. Well, let's start with the original entry that started this whole thing, and that was the collection of rent on November 2nd. And we were paid in cash, $2,400, an asset account increased with a debit, and we credited unearned rent, a liability account, because we owe the use of that rental property, $2,400. The adjusting entry on December 31st is to debit unearned rent, $1,600, which reduces the liability account, and credit rent income, $1,600, and of course rent income is a revenue account increased with a credit. Adjusting entry for accrued expenses. Any expenses that a business has incurred must be recorded before preparing financial statements in order to get a true measure of profitability. The act of recording expenses that have not been paid is called accruing expenses. One common example is wages paid to employees. Many organizations pay their employees on Friday. Wages expenses generally recorded only when wages are paid. Therefore, if the accounting period ends on a day other than payday, the employees will have earned wages that have not been recorded as an expense, and these wages must be accrued. So for example, assume that on December 31st, it's a Wednesday. On that date, Huber Rental Properties owes $500 in wages to its employees. These wages will be paid on Friday, the usual payday. So what has happened? With Wednesday being December 31st, then Monday, Tuesday, Wednesday, the wages were earned by the employees, i.e. the expense was incurred by the company by Wednesday, December 31st. Therefore, it is a liability at that date and time. But they're not going to be paid until 2 days later. So what would be the original entry? Actually, there would not be one, because nothing got recorded in the records until the expense has been incurred. So when it comes to something like this, there is no original entry. How about the adjusting entry? Well, the adjusting entry is going to be debit to wages expense, $500, and a credit to wages payable, $500. Wage expense is an expense account, increased with a debit, affecting net income, and wages payable is a liability account on the balance sheet, credit $500, which increases that liability. Adjusting entry for accrued revenues. Any revenue that a business has earned must be recorded before preparing financial statements in order to get a true measure of profitability. The act of recording revenues that have not been received is called accruing revenues. One example of accrued revenue is interest. Assume that a company charges its customers interest whenever they ask for more than 30 days to pay for a credit purchase. The interest is paid at the same time as the receivable. At the end of an accounting period, that company may have earned interest that it has not received. Since the customer has not paid the account, that interest must be recorded in a revenue account to show it has been earned, and a receivable account to show it will be received in the future. For example, let's say that Atherton Plumbing granted a customer additional time to pay an invoice. However, the customer must pay interest at a rate of 10% annually. At the end of the accounting period, the interest that has accumulated totals $80. Okay? So again, no original entry, because nothing has ever been done to the books and records regarding this $80. Okay? However, at the end of the accounting period, we need to recognize the fact that we earned it even though we have not received it. So what do? We debit an account we can call interest, called interest receivable, $80, and we credit interest income, $80. So what type of accounts are these? Interest receivable is an asset account, much like accounts receivable. So it's increased with a debit. Which statement is it on? It's on the balance sheet. Interest and income is a revenue account. And where does the revenue account go? It ends up on the income statement. Adjusting entry for depreciation. The accrual basis of accounting requires business owners to allocate the cost of long-term assets to the years they are used. This process is called depreciation. Whenever an asset is used up in running a business, it must be recorded as an expense. Similar to supplies or prepaid insurance, a fixed asset will not last forever. Its usefulness will eventually expire. Therefore, a portion of the fixed asset will be recorded as an expense in each year it is used. The matching principle dictates that all costs incurred in running a business must be matched against the revenues they generate. Assume the fixed asset is estimated to last for 3 years. A portion of the cost of the fixed asset must be matched against the revenue earned in each of those 3 years. Okay, here's an example. A florist purchases a delivery van for $12,000, and we estimate up front that the van will last 3 years. So what is the florist cost for the year for this van? In terms of depreciation, the answer would be $4,000. Okay, and that $4,000, of course, is 12,000 divided by 3. That's the basic straight line depreciation method. Okay, going back to the original entry that started this, if we bought the delivery van on January 1st, then we would debit delivery van, credit cash on January 1st, $12,000. Delivery van is an asset account, more specifically a fixed asset account. And we'll talk about a lot more about fixed assets and depreciation in the fixed assets chapter later. Cash is an asset also. We decrease that with a credit. Now the adjusting entry that needs to be made on December 31st is a debit to depreciation expense, $4,000, and a credit to accumulated depreciation, $4,000. Depreciation expense, of course, is an expense account. It increases with a debit, and it is on the income statement. The accumulated depreciation is a new account for us, a new account type even. It's a contra asset account because it goes against the asset, delivery van. So it will reduces its book value, and we'll see that on the next slide. It is a contra asset account shown in the asset section of the balance sheet. The accumulated depreciation and book value. The account credited by the adjusting entry is accumulated depreciation dash delivery van, if you want to get more specific. This is a contra asset account, an account that works against another asset account to reduce it. The accumulated depreciation delivery van account, it works against the delivery van account. So the normal balance is a credit. So on the financial statements, you would see delivery van, $12,000. You would see the total accumulated depreciation, $4,000, and the difference, called the net book value, $8,000.